When you look at a complex system failure, say an airplane engine seizing mid-flight or maybe a regional power grid collapsing, the diagnostic sensors on the dashboard, they usually flash red long before the actual catastrophe.
Right, yeah. The software tells you the temperature is too high or, the pressure is dropping.
Exactly. The digital readouts give you this illusion that you have total visibility into the machine. But eventually, well, you have to open the casing.
You have to look at the twisted metal.
Right. The burn wires, the actual physical reality of the failure. So, welcome to the deep dive. And
Yeah.
we really consider you, the listener, as the essential third person in this conversation today.
Absolute.
Because today we are attempting to look past the flashing digital readouts of the global economy and really examine the physical engine underneath.
And we have a really formidable stack of material to get through today.
We do. We're looking at comprehensive global macroeconomic analysis dated May 27, 2026. We've got corporate earnings spanning from tech all the way to retail.
Plus, that incredibly revealing recent speech from Federal Reserve Governor Lisa Cook at Stanford.
Yeah, and a massive flurry of real-time market reporting. Our goal for this deep dive is to synthesize these seemingly disparate signals. I mean, we're tracking everything from a potential geopolitical ceasefire in the Middle East to a multi-trillion-dollar artificial intelligence infrastructure boom.
Right, all to understand exactly where the global economy stands today and where it's heading.
Okay, let's unpack this because the central paradox of this material is just wild. We are supposedly in this era of weightless digital AI, right?
Right, the cloud.
Exactly, the cloud. Yet the biggest economic shocks right now are deeply physical. I mean, we're talking about water, electricity, ships in a strait, and specialty construction labor.
What's fascinating here is how global central banks and markets are currently playing this massive game of tug of war
A tug of war between what exactly?
between structural tech easing, the software making things vastly more efficient, and sticky physical inflation, which is dragging everything back down to earth.
So let's start with that macro picture of inflation because, well, it dictates everything else. And right now, the data is defying expectations in some highly specific ways.
It really is, especially in the U.S.
Yeah. For the 12 months ending in April 2026, core PCE is sitting at 3.3%, and headline PCE is at 3.8%.
Which is not what anyone wanted to see at this stage.
No, not at all. And Governor Lisa Cook explicitly warned at Stanford that inflation is moving in a, quote, challenging direction.
And the specific drivers she highlighted are what make this so unique. It's not just the standard energy spikes we're used to.
Right. She pointed directly to the $1.5 trillion in announced AI data center plans.
Yeah, that is a staggering amount of structural demand, and it's triggering severe price shocks for raw inputs.
Exactly. I mean, the data shows electricity and water prices have surged 5% over the past year.
Says over 1 year, yeah.
Plus rapidly escalating wages in specialty construction. But wait, we keep hearing AI is going to make everything cheaper and more efficient.
That's the narrative, yes.
But it sounds like building the brain of AI requires so much physical material that it's actually driving up the cost of basic utilities. It's like we're building a futuristic digital city, but draining the local reservoir to do it.
That is a perfect analogy. You cannot train or run these advanced generative AI models without sprawling server farms. And those processors generate unprecedented heat.
So they need massive cooling systems.
Right, which require astronomical volumes of water alongside uninterrupted massive baseload power. So when developers drop a gigawatt-scale data center into a local grid, it radically alters the utility consumption curve for that entire region.
And a 5% surge in utility prices bleeds directly into broader inflation metrics, right?
Exactly. It embeds higher operating costs into every single other industry on that local grid.
Which creates a massive headache for central banks
Right.
because you have this global monetary divergence happening right now as they try to figure out how to handle it.
We really see that tension tearing central bank committees apart globally. Look at the Reserve Bank of New Zealand.
Oh yeah, the RBNZ data, that was a completely split vote.
An incredibly tight 3-3 split vote, which is just unheard of. Governor Anna Bremen had to break the tie to hold the rate at 2.25%.
Why is a tiebreaker so significant there?
Well, because it's the first time they've needed a tiebreaker since the committee formed back in 2019. It shows a fundamental disagreement on the underlying economic reality.
Wow.
Yeah, the hawkish side of the committee push the terminal rate projection up to 3.28%.
Because they're projecting inflation to hit 4.3%.
Exactly. They see these physical supply shocks, energy, housing, infrastructure anchoring inflation too high.
And then you contrast that with Australia. Their headline CPI dropped to 4.2%.
But that's highly misleading.
Right, because of the federal fuel excise cut.
Yeah, when you strip away that government intervention, the underlying trimmed mean is still stubbornly holding at 3.4%.
And their housing inflation is still running at 4.1%.
Right. You cannot print houses, just like you cannot print copper wire for data centers. The physical reality is way more stubborn than the headline metric.
And we're seeing similar friction in South Africa, right?
Yes, highly divided financial markets ahead of their Monetary Policy Committee meeting.
They're trying to balance inflation against a steady rand, which the data notes is sitting around 16.35 to the dollar.
It's all the same paradigm. Policymakers are trapped using interest rates to fix physical supply-side deficits.
And meanwhile, the U.S. labor market remains incredibly resilient. Unemployment is steady at 4.3%.
Which means the localized tech inflation quickly becomes generalized inflation because the labor pool is so tight.
And the housing data reflects that too. The Case-Shiller 20-city composite was up 1.0% month over month. That persistent asset side inflation is just not going away.
No, it's deeply structural.
Which brings us to the energy side of things. We just established that energy spikes are one of the main drivers of this sticky inflation.
Yes, historically speaking, absolutely.
But literally overnight, the geopolitical narrative completely flipped. It just pulled the rug out from under those energy prices.
The repricing event across global commodity markets was violent and instantaneous.
Yeah, the catalyst here was a draft memorandum of understanding between the United States and Iran.
Right, a draft agreement.
Exactly. It's aimed at ending military conflict and lifting the Persian Gulf blockade. And the market reaction, crude plummeted over 5%.
Yeah, WTI settled at 88.68 and Brent dropped to 92.25.
Now, we need to be very careful here and just impartially report what the sources are saying.
Right, because the political rhetoric is highly contradictory.
Exactly. Former President Trump publicly downplayed the imminence of any finalized deal, and the U.S. military recently conducted what they termed localized self-defense strikes in southern Iran.
Targeting missile and mine-laying infrastructure, according to the reports.
Right. But at the same time, Iranian state television reported that the agreement mandates U.S. naval withdrawal in exchange for the strait reopening. We are merely reporting the claims from the source texts here.
We aren't endorsing any national viewpoint, but the critical takeaway is what the financial markets are doing.
Right. They are choosing to price in the ceasefire regardless of the rhetoric.
Because they are looking at the real-time shipping data.
Which is fascinating. The sources show that 33 vessels transited the strait within a 24-hour window.
And that was with explicit authorization from the Islamic Revolutionary Guard Corps Navy. To algorithmic traders, that physical transit overrides any political statements.
But the experts are totally split on what this actually means long-term.
Absolutely. JP Morgan is maintaining a bearish forecast of $60 a barrel in 2026.
Based on non-OPEC supply growth, right?
Yes. But then you have Piper Sandler warning about the physical reality again.
Right, the damage.
Yeah. The physical damage to the energy infrastructure around the strait will take months to repair. Pipelines, ports, clearing debris.
So if it takes months to actually fix the pipelines and ports, aren't the markets getting a little ahead of themselves by dropping prices 5% instantly? Are we staring down a summer supply shortage?
It's very possible. Markets notoriously struggle to price temporal physical constraints. They price the MOU as if the oil is already flowing perfectly today.
And the equity markets responded immediately to that assumption.
Oh, massively.
Airlines like Norwegian, United, and Delta rallied hard on this news, expecting cheaper fuel. But the oil companies, Exxon, Chevron, Halliburton, they just sank.
Right, which assumes that $92 for Brent is the new ceiling. If Piper Sandler is right about the repair lag, those airline rallies are built on a fundamentally flawed premise.
Well, while Wall Street reacts instantly to paper contracts and oil prices, the actual businesses on the ground in the real economy are experiencing this bizarre split reality.
The domestic U.S. activity data shows a profound fracture.
Let's start with the big guys. The Richmond Fed Manufacturing Index completely surprised everyone.
It really did.
It jumped from 3 all the way to 13, completely obliterating the consensus expectation, which was just 4.
The highest since 2021.
Yeah. The optimism in shipments, new orders, and employment indexes, it's all surging.
But if we connect this to the bigger picture, you have to immediately contrast that with the National Federation of Independent Business survey.
The NFIB data.
Right.
Small business optimism just collapsed across all industries.
The pain points are incredibly severe. Retail sentiment is dismal. Only 4% of small retailers think it's a good time to expand.
Wow, 4%.
Yeah. And in construction, 46% of firms have unfilled openings.
And 56% say they have a total lack of qualified applicants.
Exactly. Plus, 64% are reporting active supply chain and tariff issues, which is forcing them to reduce inventory investments.
So why is large-scale regional manufacturing booming while small retail and construction are just suffering so badly?
Well, it's fundamentally a story of capital access.
Mm,
Big manufacturing is absorbing high interest rates much better than historical models predicted.
because they can issue corporate bonds.
Exactly, they lock in fixed rates. But small businesses are choked by the cost of capital on floating rate loans, plus tariffs, and that volatile energy pricing we talked about.
And this capital and scale advantage is also showing up in the cross-border data. Statistics Canada put out a really interesting warning about productivity.
Right, the divergence between industries plugged into U.S. demand versus those that aren't.
The data shows Canadian industries dependent on U.S. demand grew their productivity by 4.4%.
Which is huge.
Yeah, compared to just 0.5% for the other sectors.
But that integration is also a massive vulnerability.
Exactly, because of potential U.S. tariff actions. The data specifically noted the threat from things like the Connected Vehicle Security Act.
Right, if that frictionless border flow is altered, that 4.4% growth could get crushed.
And again, we're just neutrally presenting this as an economic risk factor noted in the data, but the vulnerability is real.
Oh, absolutely.
So we've seen how macro trends are splitting the real economy. Now, let's look at how these exact same forces are creating massive winners and losers in the latest corporate earnings.
The corporate earnings really validate everything we've just discussed about capital access and AI infrastructure.
It's the hardware and software AI boom in full effect.
Yeah.
Look at Micron Technology.
Yes.
They just hit a $1 trillion market cap following a 19% jump.
Driven by an upgrade from UBS, yeah.
Right. And it's all based on this insatiable demand for the advanced memory chips needed for AI. I mean, the whole AI trade pushed Taiwan's market up to $5 trillion.
The sheer capital velocity of the AI build-out is staggering.
And then you look at software. Salesforce had a massive Q1, $11.13 billion in revenue, which is up 13%.
But the real story there is how they are monetizing AI.
Yes, their Agentforce and Data 360 platforms hit $3.4 billion in annual recurring revenue.
Which is a 200% increase.
Unbelievable. Plus, they integrated Informatica Cloud, and they had enough cash for a $25 billion accelerated share repurchase.
They're generating immense cash flow. And we see it with Snowflake, too.
Right. Snowflake's product revenue grew 34%. They now have 779 customers spending over $1 million annually.
And Synopsys is integrating Ansys and raising their guidance.
Even HP Inc. is winning, but specifically in the commercial PC refresh cycle.
Right. Commercial sales were up 14%, offsetting the declines in consumer hardware. Enterprise IT is upgrading for AI workloads.
Okay, here's where it gets really interesting. This whole tech landscape right now, it's like a gold rush, but the money isn't just in the gold, which would be the AI software.
Right.
It's in the pickaxes and the infrastructure. Companies like Micron, HP's commercial PCs, Synopsys, they are building the foundation.
Because they are building the foundation, they have vast cash reserves. They are largely immune to the credit pressures choking the retail side.
Which brings us to the retail and e-commerce struggle. It is a completely different world.
It really is.
Look at PDD Holdings in China, a landmark miss.
Yeah, their revenue missed estimates. Non-GAAP EPS was a 37% miss.
And the stock hit a 52-week low. Why? Because of those physical constraints. High fulfillment fees, surging server costs, and long-term infrastructure investments are just hurting their short-term profits.
Wall Street relentlessly punishes margin compression in a high-rate environment, even if the company is building for the long term.
And the geographic divide is brutal, too. Abercrombie surged 12% on record sales, right?
Yes, but look at where those sales happened.
Exactly. The Americas were up 3%, APAC was up 24%, but EMEA was down 10%.
Because of the Middle East conflicts.
Right. Physical geopolitical friction instantly creates corporate margin decay.
And then there's Bath & Body Works.
Oh, this one is wild. They beat EPS estimates.
But only because of an $88 million credit card fee litigation settlement.
Right, a legal windfall. Their actual sales fell 3% due to tariff and energy costs,
And their CFO resigned alongside the report.
which is never a great signal. And finally, Lululemon. They had to settle a proxy battle with their founder, Chick Wilson,
Right. They agreed to a, quote, pledge of peace and gave up board seats.
after the stock plummeted 60% from its 2023 highs.
Survival right now belongs to agile enterprises. If you have the cash-rich software margins of a Salesforce, you can expand.
But if you are in retail managing physical inventory, you are dealing with massive margin compression.
You have to realign supply chains away from geopolitical risks while absorbing energy spikes. It's incredibly difficult.
So it's very clear AI is fundamentally reshaping corporate balance sheets and it's driving inflation. But how are the regulators, the people tasked with keeping this whole system stable, how are they handling this new era?
Well, returning to Governor Cook's speech at Stanford, we get a direct look at that.
Right, the Federal Reserve's internal AI usage. And we need to clarify her point right off the bat. The FOMC is not using AI to set monetary policy.
Right. They're not letting an algorithm set interest rates.
Yeah.
But the Division of Financial Stability, the DFS, they are using it to monitor vulnerabilities.
And they have this active knowledge distillation project, which sounds like sci-fi, but it's actually super practical.
It is. They need to monitor massive text, corporate regulatory filings, earnings calls, all of that.
So they make a small, cost-efficient AI model that classifies all this text, and they achieved an 80% reduction in computing cost compared to using massive models.
Which is brilliant. But the laboratory experiments using large language models, or LLMs, are even more systemic.
Yeah, Fed economists found that AI agents actually make more rational, data-driven decisions than human traders do.
Right, potentially reducing the, quote, animal spirits and herd behavior that historically cause asset bubbles and panics.
Which is fascinating, but think about that. If trading becomes dominated by rational AI instead of emotional humans, do market panics disappear? Or do we just get new, faster, more complex panics?
Well, that's the risk of endogenous model collusion.
Explain that.
If multiple AI models independently figure out that correlated trading or implicit collusion maximizes profit, they might execute it.
So they accidentally team up to corner a market.
Exactly, without explicit human direction. It creates massive market concentration risks.
And there are serious cyber risks with generative AI, too.
Yes. The sources highlighted Anthropic's Mythos preview model.
Right. It detected previously undetectable software vulnerabilities in core systems, which is a double-edged sword.
A huge double-edged sword for financial cybersecurity. You can audit your own systems, but malicious actors can exploit those 0 days at scale.
And to build these massive, rational vulnerability finding models, you need immense physical infrastructure.
Which brings us to the debt market boom.
Right. Hyperscalers and small data center developers are using private debt and asset-backed credit to fund this AI infrastructure.
Which raises long-term financial stability questions about leverage.
Because if the AI boom falters, all that debt is sitting on half-built, power-hungry data centers.
This raises an important question about how regulators manage this transition. The Fed's approach is experimentation paired with strict human verification.
Right. They ran an agentic AI sprint across the reserve banks.
And they proved AI is actually much better at identifying complex, network-based risks.
But it requires a system architecture that forces AI agents to consider contrarian perspectives so it doesn't just hallucinate a crisis. It's just a wild time in the global economy. I want to thank you, the listener, for joining us on this exploration today. We've really covered a world caught between two extremes.
The frictionless digital frontier of things like Agentforce on one side.
And the heavy physical realities of the Strait of Hormuz on the other.
It's the defining tension of our current market.
Absolutely. So as we wrap up, we want to leave you with a final unaddressed question drawn directly from all these sources.
A thought experiment.
Right. We heard that AI might make financial markets more rational, theoretically preventing human-driven asset bubbles.
Which sounds great on paper.
But if the hyperscalers are loading up on unprecedented amounts of private debt to build these power-hungry data centers, which is actively driving up the cost of water and electricity for everyone else, is the AI economy actually a brilliant software revolution?
Right.
Or is it just the most resource-intensive, highly leveraged physical infrastructure bubble we've ever seen?
Something to think about.
Definitely. Keep questioning the data, keep looking past the dashboard, and we'll catch you on the next deep dive.